Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And today on the podcast, we're going to give sort of a general look at where inflation's going, what the Fed is doing, some good signs, some bad signs, but all in the context of what Powell has said the Fed's goal is and what their modus operandi is going to be going forward. So, but before I get started, I just want to thank our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies, perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us, that's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. And this podcast, as always, is sponsored by Enduring Investments. Enduring Investments was founded to help institutions and individuals defend your money. Our unique strategies can help you if you're saving for your own retirement or for a group of retirees in Quebec or anything else. We can also help with managing and hedging supply chain cost pressures if you run a business. Visit us at enduringinvestments.com. You know, there are a couple times per year when the amount of work for an entrepreneur, and this entrepreneur in particular, just sort of mounts up, and the podcast and the blog just gets pushed to the back burner. And we've obviously just had one of those. The last time I posted was right after the CPI report. And these times usually, correspond to travel. If I'm doing a lot of travel and have a bunch of other stuff to do, obviously, my customers come first. And then naturally there's interviewing new customers and talking to potential consulting clients. And don't forget about new product development and research and things like that. Those are all excuses, and they aren't your problem as the listener. You just want the podcast, dang it. But there's a job to be done, and we have to keep at it until the job is done. Which brings me to Powell. A couple of weeks ago, I did a podcast on famous last words, and there's a link in the show notes. And I noted Powell's line at the time that he didn't see the stag or the inflation as being potentially something which could go down as a famous last word. It's cute and pithy, wasn't scripted, and really sort of tempting the fates by saying something like that. And it's a great candidate for famous last words. But more significant than that were his words back in August of last year at the Jackson Hole Fed conference, shortly after what has, at least so far, been the last tightening move of the cycle, the last rate hike move of the cycle. And here's what he said then.
As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
At that point, the Fed went from monetary policy to Mummenschanz policy. For those of you who don't get that reference, you can look at the podcast notes for the odd reference to Mummenschanz. But what I mean is that at that point, the Fed started to work hard on its choreography and coordinating the message of higher for longer, jawboning the markets to keep them from overreacting to what seemed like to the markets and to investors like it was the end of the rate move. The Fed has been mostly successful, I guess piecemeal successful, sometimes successful, a little bit, sometimes less successful. At the markets at one point after the Fed, after Powell had spoken, I guess a couple of months later and into the end of last year, the markets got really bullish about rate cuts and priced in 6 or more rate cuts for 2024. By the way, have we seen any of those yet? We have not. But anyway, the market kind of started pricing in these massive rate cuts, and then eventually, thanks to the Fed's jawboning, eventually priced those mostly out. Now, arguably, it wasn't as much the jawboning from the Fed as much as the data coming in, being a little stronger than I think folks had expected. That persuaded markets that declining interest rates weren't about to happen immediately. But if the Fed had not been jawboning, I don't think investors would have been giving them so much hawkish cred when the data stayed firm. And at the very least, the Fed, I think, should get some credit for the decent choreography. Recently, the Fed did start to move the arrow in the direction of easier policy by lessening the pace of quantitative tightening. So quantitative easing was when the Fed bought lots of bonds and therefore increased its balance sheet a whole bunch. And when you buy bonds, of course, you have to spend money. You push money into the system, and the Fed basically prints the money that they're they buy the bonds, and then they credit the banks they bought them from, and that's how money gets into the system. So that's quantitative easing. And quantitative tightening. And let me back up a second. That's quantitative easing when it's sort of done in a systematic way to greatly increase the balance sheet. Over time, the Fed has always sort of, bought bonds to gradually increase the balance sheet and gradually increase the money in the system with a growing economy. The quantitative easing is when the Fed's doing it in huge size for a long period of time. And quantitative tightening, on the flip side, is when the Fed either lets bonds roll off the balance sheet, just mature and not replace them on the balance sheet, or actively sells bonds into the marketplace, taking in money, which then effectively gets destroyed and exits the money supply. To be sure, the quantitative tightening, or the decrease in the quantitative tightening that the Fed recently, they decreased the amount of bonds that they were letting roll off, okay? And to be sure, they did this because of perceived technical issues involving money market liquidity that are sort of beyond my scope here, but there's no question that shrinking the balance sheet more slowly is less hawkish, whatever the motivation for doing that is, okay? And so therefore more dovish. Longtime listeners know that I've been really consistent here that what matters for inflation is money supply growth. And the Fed's most direct way to influence that used to be changing the size of the balance sheet and putting more money in and therefore more reserves when they wanted faster money growth, and having that reserve growth be much slower when they wanted less money growth. Because if you constrain the quantity of reserves, banks require reserves in order to be able to make loans. And so if, in fact, you are constraining the quantity of reserves, then you're constraining the amount of money creation, the amount of lending that banks can do. Well, banks are no longer reserve constrained. They're capital constrained. And so the balance sheet is no longer a great tool for affecting money supply growth. That being said, a smaller balance sheet that's closer to that margin is clearly a better thing. And so this direction has clearly been a hawkish development, although maybe less hawkish than if, in fact, banks were still kind of on the margin in terms of, using all of the reserves that were available. Anyway, as an aside, if the Fed sold every bond that they currently have on the balance sheet, they could not drain all of the money that they put into the economy, because the prices that they would be selling those bonds at now with the higher interest rates are lower than the prices that they originally bought those bonds at, okay? So I buy a bond for $120, okay? I put $120 into the system. Now the price of that bond declines to 90. So I sell the bond. I take $90 out of the system. Okay, so net, I have no bonds on my balance sheet anymore, but there's a net $30 in the system. Okay, so sort of systematically, when they go through these big periods of great quantitative easing and then great quantitative tightening, they gradually get additional money into the system that just is not drainable, which is, again, that's sort of beyond our scope of talking about today, but it is sort of a funny and interesting thing to keep in mind. Again, we're a long way away from banks being reserve constrained, but if the Fed really wanted to make them reserve constrained, it's not entirely clear that they could. Anyway, at this size of a balance sheet, it isn't as if slowing the runoff is a big dovish effect, but it's in the right direction. Okay, so we know that the Fed is moving more easily. And you know what? I've totally over-belabored this point, and I'm going to move on. So at the same time as all this is happening, M2 growth has turned positive again. Since the end of 2022, M2 growth has been negative on a year-on-year basis. Okay, and again, something I've talked about quite a bit on this podcast. It's never been very negative, but it's been a little bit negative, and inflation has only stayed high because of rebounding money velocity. Okay, again, we've talked a lot about this, about the car that's speeding away and the wagon is attached by a spring. Okay, and the contraction of that spring is the rebound in money supply in velocity. Okay, so we've talked a lot about this, but if at some point velocity will have fully rebounded, and when that happens, slow money growth will more directly translate into slower inflation. Not lower prices, mind you, unless the money supply actually continues to decline, but slower increases in prices, which means lower inflation. Now, the rebound in velocity could be over soon. It could be over, it might take a year or two, but it's clearly closer to being over than it was when we started this whole episode. And so it's very important to keep at it until the job is done, to quote Powell. So the question naturally is the job done? Well, currently the signs of softening growth are increasing. Many of us, including me, who expected a recession in 2024, frankly, I think I expected a recession of some kind in 2023. We've been wrong for a while, right? I mean, a lot of folks have been looking for a recession for a while because, the usual cadence of these things sort of suggested that was the right time frame. All of the usual patterns naturally sort of messed up because of the wild swings in money we've seen and the fiscal recklessness we've seen. But nevertheless, I'm on record as saying that if we got 500 basis points of tightening and rapidly rising energy prices as we did in 2022 and 2023, and we did not have a recession, it would be a first. Well, it's a first. We got those things, and we have not yet had a recession. But the business cycle hasn't been repealed. And although we can expect robust federal spending heading into the election, we're still seeing signs of weakness in the consumer. Rising delinquencies, for example. Recently, some of the manufacturing surveys have been a little bit weak. And I think importantly, certain companies that sell convenience goods or cater to middle-income people, companies like Walgreens, Walmart, Target, McDonald's, even Starbucks, have reported softening demand and increased pushback on prices. And sort of the latest quarterly reports, and if you listen to the conference call, the investor calls after those reports, that's the sort of that's the things that we're hearing, and that's what we're hearing from those companies that tend to be dealing with consumers who are not living on Martha's Vineyard. They're living in the real world, right? So we have to, there are some signs here about kind of slowing growth. And as another aside, that's how slowing money growth manifests. Okay, when there's plenty of money, people show less resistance to price increases, and so that's what happened when the COVID money drops happened. Everybody, well, on average, people had more money. And so when we had these COVID money drops, and it continued for a while, eventually when money growth gets restrained, then it means the average person's money balances aren't increasing. And that manifests eventually as more pushback on prices. Now, just because consumers don't like higher prices, and of course they never like higher prices, and they'll always complain about higher prices, but just because they don't like them doesn't mean they won't pay them. And that's what we want to know, right, is whether people are still paying these higher prices. But if Walmart is talking about pushback, what they mean is not that people are complaining about higher prices. They mean that what they're seeing is a demand response to higher prices now. So when Walmart or Target says the consumer is less resilient, that what they mean is that the consumer is not seeing the liquidity on average that they did before, and therefore they're being a little bit more reluctant to pay those higher prices, and so those companies are seeing a demand response, and that is what we would expect to eventually see with slowing money growth, and we're now finally kind of seeing that. And obviously that also, I think the way investors think about this is that, hey, that's slowing economic growth, which it may be, but those are sort of separate issues. And with the weakening economic growth, whether it's those reports, whether it's the reports from manufacturing concerns, whether it's increasing delinquencies, and so on, we've seen markets start to react again. Yields across the curve have fallen 25 to 40 basis points since the end of April, which is not huge, but people are starting to price in some eases again. I think this time they're probably right. We're probably going to get an ease in 2024, but there's not going to be a ton of them. It might even happen soon. Probably will happen before the election, but we're in the right direction anyway. But is the job done? I mean, should the Fed be easing? Because Powell said he would keep after it until the job is done. Well, the job isn't done. Median CPI is still at 4.5%, and the rate of deceleration has been slowing. So it was really high. It's coming down. Median inflation got over 7%, and it's down to 4.48. Okay. But the rate of deceleration is slowing. And so if you sort of think about this as a mean reverting process, then it looks like it's mean reverting to 4%, not to 2, not to 2.5. Core looks like it's mean reverting. It's doing the same sort of thing. It's coming down, but it's coming down at a slower and slower pace. And it looks like it's mean reverting to about 3.5%. Money supply has turned positive, still very low, but it's accelerating. So the job, if by the job we mean getting inflation back to being low and stable, is clearly not done. So will the Fed ease? I think so, partly because they're concerned about the recession and partly because they're concerned about the election. And as my final aside of the day, last week there was a Bloomberg poll. And the poll was, what is the chance the Fed loses its independence if Trump is elected? And so I have two observations on this. And the first observation is, do you really think the Fed is independent now? I mean, perhaps they're immune to being directly ordered to do something. And by the way, they'll remain immune to being directly ordered to do something unless Congress changes that. But do you really think that no one at the White House, you don't think Yellen is talking to Powell and saying, hey, we could really use some lower interest rates here? I mean, it's not like the Fed is immune to political pressure, right? They don't necessarily have to do anything, but they read the papers, right? They have to go and they go out and give speeches. So they're not really as an independent now. They are de jure independent. By law, they're independent, but in practice, they're really not 100% independent, right? People at the Fed are listening to what the White House is saying. We don't really think the Fed is truly independent now.
Come on, man.
And my second observation is that while the Fed losing its independence is bad, it's mostly economists who say that, right? Because it used to be assumed that a central bank under the sway of the central government would be inflationary, because the central government would love to be able to, push more money into the system whenever it was convenient to do so. And they would be much less likely to want to restrain that money when it was convenient to do so. Because it was always assumed that pushing more money caused growth and pulling back on the money causes less growth. That's not quite so clear. The amount of money in the system affects inflation. It's not so clear that it affects growth in quite the same way. But anyway, the point is we've sort of crossed the bridge about whether or not, the Fed is doing what the central government wants it to do. The Fed printed money during COVID, which they probably had to, but they didn't pull it back when they should have. The Fed is not a well-run institution, and a revamp is probably needed. That has to come from Congress. Okay, Congress would have to change how the Fed operates, and it probably should. I mean, I think I would change the law to make sure that at least one monetarist is on the board at all times. It's been a long time since we had a serious monetarist at the Fed, and that's part of what has led to the situation we're in now with high inflation that is not coming down doesn't look like it's going to come down all the way to where they want it to, and that's because they're not using the right framework to analyze what monetary policy ought to be. In other words, the job isn't done. Without a monetarist, it's probably not going to get done, but that's all for today's podcast. I'm really sorry that this one was it seems kind of disjointed, and I guess if I don't do a podcast for a couple weeks, I get out of the habit a little bit. So I'm sorry if this one seemed a little bit more disjointed than normal, but I'm trying. Give me some credit for trying. That's all for today's podcast, though. Please subscribe, and refer others. Maybe you refer them to one of the better episodes. Maybe not this one. I don't know. Anyway, you can contact me at inflationguy@enduringinvestments.com. And subscribe for free to the blog at inflationguy.blog. Follow me on X at inflation_guy. And visit Enduring Investments. Please visit Enduring Investments if you need supply chain hedging or help with diagnosing and treating an inflation problem or defending your money. And please defend your money. And if inflation is coming for you, remember, you know a guy.